Morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1Mby1M, as you know, is the first global virtual accelerator for technology startups. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of that mission, we do these roundtables week after these free roundtables, week after week after week. And it's been going on since the fall of 2008. It precedes the 1Mby1M program. In fact, it is the experiment that led us to the 1Mby1M program to be able to do online mentoring long before COVID made it normal. You know, online mentoring in 2010 when we started was definitely not the way the industry operated. And I actually believe that the future of startup accelerators is virtual and it's equity free. 1 million by 1 million does not charge equity, and it is a very important feature in our design that makes it possible for us to work with entrepreneurs at any stage. We can do, you know, pre-idea, pre-product, pre-revenue, pre-validation, pre-everything. And the more you look at the, you know, brand name accelerators that like Y Combinator and so forth, the more you will see that there is a lot of work that has already gone into companies that they are accepting into those accelerators. I saw somewhere that Y Combinator has accepted a company that has 7 million ARR already. So that's definitely not a requirement for 1 million by 1 million. I'm going to spend some time talking about a bunch of issues that we have just released a paper on. Let me also point you to the 1Mby1M AI mentor that you can work with 24/7 in 57 languages. It's essentially trained on my digital mind. It's 20 years of my mentoring session recordings and writings, case studies, everything that I've been up to that has a digital footprint has gone into training the AI mentor. And as a companion to the AI mentor, we have released a free Udemy course which has AI mentoring prompts to work with that AI mentor to develop your startup strategy. So I strongly recommend that you start working with the AI mentor ASAP and run your slide deck through the AI mentor, start, you know, developing a relationship with the AI mentor, and then take the questions from the Udemy course and run each of those batteries of questions to get input from the AI mentor on developing your strategy. I would like to spend maybe 10-15 minutes talking about how do you maximize the probability of startup success. So startup success is a probability game, and it is a low probability game. So the only way you're going to succeed is to really understand what is the business you're about to do and making the right decisions that maximize the probability of your success. To read the Zeitgeist, it feels like the only way you can achieve startup success is by becoming a unicorn and being heavily funded by venture capital. That is a myth. It seems like it is reality, but it is a myth. Unicorn is one form of success. What is a unicorn? A unicorn is when a startup achieves $1 billion valuation. Now, achieving $1 billion valuation is not necessarily success. There are many ways a unicorn company fails. One of them is death by overfunding. We're currently going through an explosion in the fund sizes, and very large funds are operating in the market, and very large funds cannot write modest sized checks. They have to write very large checks, and they do so by bloating up the valuation and writing big checks. And you may ask the question, why do they have to raise these big funds and write these big checks? The answer is big funds get very big management fees, even before they have to show any return on investment. They get paid a lot of money, which is a percentage of the fund's asset under management. And if that asset under management number is large, the percentage that accrues to the venture capitalists, the general partners, also ends up being very large. So that's one of the ways VCs make money, is through very large management fees. But the problem is your reality as an entrepreneur is very different. You're not a venture capitalist. Nobody is paying you management fees. You can raise a lot of money and pay yourself a big salary. That is fine. That is one way to make some money if you are playing this game. But that doesn't necessarily mean that you're going to create generational wealth, because very few unicorn companies actually exit at unicorn valuation, whether it's through M&A or through IPO. Achieving a proper exit is not that simple. And it's a very, very low probability game. 0.01% of venture-funded startups actually become unicorns. And from the ones that become unicorns, many become zombie unicorns. We have published papers on this as well. You can find the statistics on zombie unicorns in our published papers. It is one of the ways startups fail, is becoming zombie unicorns. But without being a unicorn, you can also not succeed in achieving a wealth creation event. So there are essentially exits come in two forms. If you raise venture capital, you have to achieve an exit to be a success. Exits come in two forms. Either it's an IPO or it's an M&A exit. To be successful in the public market, you need real fundamentals. We've seen a lot of unicorn valuation private companies go out and become a public company, and then the valuation collapses completely. And probably the most prominent success in current times of achieving huge valuation and going public at a huge valuation is SpaceX, $1 trillion plus. But if you look at what's happening post-IPO there, the stock is collapsing completely. And this is a very common occurrence for people who are chasing unicorns, and even the ones who, very minuscule percentage actually achieve unicorn valuation, but even the ones who do achieve unicorn valuation at IPO often cannot sustain. And you, as an entrepreneur, will not be able to sell your stocks at IPO. You're going to be under lockup. So by the time you end up selling your stocks, the stock has collapsed in the public market and you make no money. So it's a very complex equation, this unicorn chasing business. The other problem that you have to think about in your assessment of the probability of how you become a successful entrepreneur and create wealth for yourself, for your family, is the exit math. Over 96% of the exits in our industry are sub-$100 million exits. So if you get $1 billion valuation in fundraising, you're pricing yourself out of over 96% of the exits. You cannot exit at sub 100 million after you've raised valuation, after you've raised capital, venture capital at $1 billion plus valuation. The math doesn't work. And the other really complicated issue is that the vast majority of those 96% exits that are sub 100 million actually are sub 50 million. Now, for you to make money, create wealth out of a sub $50 million exit, you have to build your business in a very capital efficient way. If you raise $50 million, a $50 million exit is not going to make you any money. It's not even going to make your investors any money. They're just going to get their money back with no return. And you will get nothing, because usually investors get paid first. So if you really are playing the probability game, your best bet is to optimize for, if you raise funding, your best bet is to optimize for a sub $50 million exit and raise as little money as possible, so that you and your investors can all make money through an M&A exit that is going to be most probably under 50 million. And it's definitely going to be under 100 million. 96% probability is going to be under 100 million. So our recommendation is, if you are looking for an M&A exit with a high probability chance of getting there, you should raise a small amount of capital and try to exit without getting to absurd valuations in your fundraising. There is another way to do this and build a successful company, which is by raising no money at all, which is by bootstrapping. And bootstrapping gives you two options, two very high probability options. If you can build a sustainable business, and if you don't have outside capital in your company, you actually do not need to exit to be a successful business. As long as you're a profitable business and you grow, you don't even have to grow at a very fast pace. If you grow organically, you grow linearly, you can build a nice profitable business, pay yourself, pay your team, and from the profits build your wealth. And that is a legitimate and high probability way of building your personal wealth. And in fact, the vast majority of the world economy runs on this kind of businesses, bootstrap businesses that are profitable, that are sustainable, and that gives you a lot of options. The other way to play the bootstrapping game is bootstrapping to an exit. In that case, 100% of the exit value is yours. It's okay if you make a $20 million, $30 million, $50 million exit, all of that money goes to you if you're bootstrapping. There's no other shareholder on the cap table. And if you have co-founders, you and your co-founder split the entire proceeds of the exit. So that is a good option. The other really good option that you get if you decide to bootstrap is that you do not have to grow so fast. If you take venture capital, you have to grow really, really, really fast. You have no choice. You have to go from $0 to $100 million in 3 to 5 years. Currently, because of AI, the requirement for how fast you need to grow has increased even further. Before AI, the venture capital expectation was $0 to $100 million in 5 to 7 years. Right now, the market is operating at $0 to $100 million in 3 to 5 years. So you have to grow even faster. And because of AI, there are instances of companies that are growing really, really fast. And so you're competing with companies that are on this hyper-growth mode, and that is difficult to compete with. So if you have doubts about how fast you can grow your business, bootstrap, grow organically, figure things out, if you can hit repeatability and hit a path to velocity, that's when you can raise money. So bootstrap first, raise money later, after achieving repeatability, after achieving a good understanding of how you get to a high velocity business. That's a good path that increases your probability of success. Then I want to share with you a final point, which is that 26.5% of seed-funded businesses that got funding in Q1 of 2022 have achieved Series A. That is a very low number. That means there's a very large number of companies that have not achieved Series A. And the chances of these companies that have not gone from seed to Series A or seed to exit, seed strapping to exit is a fine outcome, but the vast majority have not. Over 75%, over 70% have not, and the chances of these companies becoming zombies is very, very high. And the zombie, what is a zombie? I'm going to recap. I've talked about this before in prior roundtables. A zombie is a company that has raised venture capital and has promised that it will grow at a very high velocity, but is failing to deliver on that high velocity growth and cannot raise more capital and cannot find an exit. So it's stuck. It is generating some revenue and it is perhaps even achieving profitability, but it is not going to be able to raise money or find an exit. And that is one of the ways companies fail. And there's a very high probability of failure if you raise venture capital of your becoming a zombie. Because 9 out of 10 startups that raise venture capital fail. And VCs factor that in. VCs assume that 1 out of 10 companies are going to have a home run success, build a unicorn, and that is going to basically pay for the entire portfolio. 3x, 5x, 10x, whatever, it will multiply the portfolio to call the portfolio a success. But you are an entrepreneur. You do not have a portfolio. You have to maximize your chance of success as an entrepreneur. So you have to maximize the different ways that you can either find an exit that is a profitable, lucrative exit, or build a sustainable business without raising outside capital. Or in this very low probability instance, you raise a lot of venture capital, become a unicorn, and find a legitimate unicorn path to success, which is a very low probability path. And if you have the business metrics with which to do that, I'm fine with it. We have done unicorn businesses here in the program, but please bootstrap first and raise money later so that you can validate that you can be a fast growth company. Now, I will caveat that by saying that if you're doing a deep tech venture that requires a lot of development work before you can start generating revenue, that is a very understandable situation. Those companies have to take this risk. If you are doing deep tech and you need capital up front without figuring out whether you can grow fast or not, that is a risk you're going to have to take. You don't have a choice. But overall, I would say if you can minimize your risk taking, that would be better. And if you can, especially if you can bootstrap first, raise money later, or not at all, that is going to give you the highest probability of success in this game. Okay, I will take questions. If you have questions, please let us know. You can unmute and talk to me anytime. I am going to give you a few pointers to how to use 1 million by 1 million. It is 100% virtual. So you go to 1Mby1M.com and you find everything there. The Digital Mind AI Mentor is available as a standalone product for $30 a month. It is also available as part of our premium and basic programs. Premium includes the private roundtables where you get weekly consulting and mentoring, coaching, whatever you call it, but you get that on a weekly basis. That's through the private roundtables. If when you're ready, we also introduce you to investors through this through the premium program. The curriculum is included in the premium program, and the AI mentor is also included in the premium program. That is $1,000 annual membership fee. Basic is curriculum only plus AI mentor. The mentoring, roundtable mentoring is not included in basic, and introductions are not included in basic. So look at the website, decide what you want to do, how you want to work with us. There are free roundtables coming up on July 30th, and therefore in August as well. So you can, participate in any of them. Just sign up and request which date you want to pitch at, and Maureen will assign you. It's first come, first serve. If you have questions about the program after today, Irina is your contact, irina@1mby1m.com. And that is it. If anybody wants to ask any question, you are welcome to do that now. Yes? No? All right. I don't see any questions. I don't see any hands up. I am going to say goodbye and see you next week.